welcome back to Cape Town. Welcome back to One-to-One Mining Investment Cape Town. It's a real pleasure to be here. So I'd like to invite our investment leaders to the stage, please. Brian Manell, CEO of TechMet, Philip Clegg, Portfolio Manager of Orion Resource Partners, Lloyd Pengilly, Chairman of Quora Capital, Kathy Nader, Principal Mining and Resources at Nedbank CIB, and Hans-Arne Lorange, who's Head of Metals and Minerals at Clarkson Securities. So thank you very much, everyone, for coming along, lending your time and lending your expertise here. If anyone has any questions throughout, raise a hand. We've got the panel here. I'm sure they'd like to be put on the spot by any challenging or opportunistic questions that we need. But look, let's get this started. I mean, it's a great time, it seems, for metals and mining. Fantastic opportunities in many respects, metals prices, etc. But also a lot of volatility, a lot of risk out there, a lot of challenges on the global macroeconomic scene. How are we making sense of the market at the moment? Brian, could I start with you?
I think we're at a very unique moment in history, certainly for the metals that we as TechMet are involved in, which are a broad range of metals going into the energy transition. You know, I think everybody recognizes that the energy transition and the electric vehicle revolution is unstoppable and accelerating. And everybody is starting to recognize that it can't succeed without adequate supply of the inputs. The extent of the supply-demand dislocation is only just beginning to dawn on the OEMs and other end users and on providers of capital and to an extent on the industry. And this creates a very unique opportunity for the junior mining sector and for African mining to play a role in the transformation of our industry, which is necessary for a successful global energy transition. And this includes, not only lithium, cobalt, nickel, rare earth metals, but also tin, also copper. So it's a pretty wide range of mined products that are at a point in history that is really not similar to anything we've seen since the impact of coal, demand for coal and iron ore in the Industrial Revolution in the late 18th, early 19th century. So, the transformation of the industry that we require, or the world requires, in terms of scale, in terms of ESG compliance and low carbon footprint, and in terms of independence from Chinese dominance over supply chain, which is an increasingly obvious geopolitical issue and national security issue on the part of the United States, Japan, Europe, and others, is really totally changing the landscape. It is not changing it quickly enough in terms of what the mining industry is doing about it, and it's not changing nearly quickly enough in terms of what providers of capital are doing to support this transformation that is absolutely essential to create a clean, sustainable world for our children and grandchildren. So it is really a time, it's an inflection point for the world from an energy and mobility point of view, but for our industry in terms of the role we have to play in that global transformation. So it is very, very exciting and very challenging. And there are a lot of elements to it that we all have to apply our minds to. And I think this is a great time to do that.
Yeah, certainly. You touched on some really good points that we can delve into amongst that. But just wanted to pick on what you were saying around sort of the OEMs, the industry providing capital to realize these projects. Who's not yet playing ball? Where's the capital going to come from to sort of realize these opportunities that you've touched on, that we've talked about, and that we kind of know about here, the converted?
The key challenge we have to face as an industry is how we access the enormous pools of ESG, climate change impact investing capital that up till now is more comfortable investing in the latest autonomous driving software startup relative to investing in metals and mining, which are the ingredients that go into all of the systems that they all want to support and promote. And to do that, we have to totally change the image of the mining industry from an ESG and compliance point of view. And in order to change the image of the mining industry, we have to change the mining industry, because there are reasons why the mining industry, in the eyes of generalist investors and ESG, climate change, impact investors, is seen as a negative. So this is, and governments, the extent of the supply-demand dislocation is is so severe, and the world has responded to it so late and so inadequately. We need massive US government, Japanese government, and European government support in parallel with China's ongoing scaling of the supply chains that they've spent 15 years building a dominant supply over in order to adequately supply these critical minerals. So, I mean, the key audiences we need to do better with are governments in terms of soft loan facilities, political insurance, and other de-risking mechanisms to reduce cost of capital, and big institutions who really needed to deploy $100 billion into our industry, 5 years ago. So we're somewhat out of time, with respect to the challenge of not retarding the energy transition 2-3 years out, which we're now going to radically because we just can't produce enough lithium and nickel and cobalt and other metals with all the best will in the world. I mean, the other constituency that's failed us radically are the big mining companies. The BHPs and Rios of this world, who have understandably been reticent to wean themselves off reaping massive rewards, mining iron ore in the Pilbara and paying massive dividends, are not engaging in our metals to the extent that they should see themselves as having a responsibility to the world and to their shareholders to deploy capital into. So they're largely out of the key critical minerals going into the energy transition, and it'll change. Rio's fiddling around with lithium, and BHP wants to do a bit more nickel, and that's nice, but it's like 5 years too late. These companies should not be paying $10 billion dividends. They should be deploying $8 billion in building nickel and lithium mines and sort of capacity to process outside of Chinese control of the metal chemicals going into batteries and electric cars and renewable energy systems.
Excellent. Kathy, could I turn to you and get the view from Nedbank? What's different as well? You've been doing this event for a long time with us. Pre-pandemic, the situation was much more different in terms of the market. Has that changed your outlook, Nedbank's lending capabilities, etc.? Sorry, can you comment on some of the things that Brian's mentioned, but also what's changed over the last couple of years for Nedbank in terms of your work in terms of raising finance for juniors?
Thanks, Adam. So we in Nedbank CIB, and we are a commercial bank that invests into mining companies on the continent and in South Africa and across all commodities. And I think, from a lending perspective, our fundamental lending principles haven't changed over the last few years. We are debt providers and we understand mining risks. So we're very focused on management, geology, all the risks associated with mining, with a position on the cost curve. From a lending perspective, I don't think our lending principles have changed. We're very aware of the new technologies and new minerals that are going to be needed to supply into decarbonisation globally. But as a debt provider, we're always waiting for the equity to come in. So we're very happy to see all the equity investors here at the one-to-one, because we will come in after equity. In the meantime, we're doing our homework, we're understanding the markets, understanding the minerals, and making sure that we're ready to allocate capital to good projects, good companies, good management teams, the same way we always have, based on good lending principles.
Just a point around the energy transition and the battery materials needed. How, as a lender, has that changed structuring of deals, the way that you lend to sort of mining companies that perhaps you wouldn't have lent to in the last cycle because there was less need for lithium, for instance, or cobalt and nickel? Is there any differentiation there between sort of, the precious metals companies, silver, etc., the bulk metals as well?
And there are differences. Precious metals, exchange traded commodities, the market is a lot more transparent. So for us, when we're looking at battery minerals, what we're focusing on is the marketing. It's opaque for us. We need to understand the counterparties. So those are the key differences. But other than that, the same lending principles apply.
Good. Lloyd, could I bring you in here and get your take on where you feel we're at in terms of this commodities and metals price market boom period? And would you care to opine on anything that Brian or Kathy have touched on so far? Do you share the same view that we're at this inflection point that's really crucial?
Well, morning, everybody. Look, I think that Brian was very eloquent in the way he summed it up, in that, we are at the beginning of something very big. For instance, we sit in the car park here today. I don't think there's an electric vehicle parked up there. In 5 years' time, I'm sure that probably 50-60% of the motor cars parked in the car park are going to be electric vehicles. So this is coming at us hard and fast. And it's the fascination to me is being driven by the politicians who've all got very excited about the ESG issues and the non-pollution issues and the removing away from carbon fuels. So this has come from the top down. The problem is that the industry worldwide is playing a catch-up game. Now, when you look at to see who's who in the zoo, you can see that there are some major companies in terms of electric generation and, dare I say it, the OEMs in putting the ideas together and the philosophy and the strategy of their businesses and where they're going. But the piece of the equation which has been lost on, dare I say it, the politicians and, dare I say it, the power manufacturers and the equipment manufacturers is the fact that the poor old mining industry is being left high and dry and being left behind in the equation. So we're playing a big catch-up game. Now, what does it all mean? It means that we've got as Brian rightly points out, we've got a major market in front of us. And I think his point about iron ore and coal at the beginning of the Industrial Revolution is a very relevant one, because that's what we've got coming at us now in the nickel, the cobalt, the manganese, all the minerals that go into these batteries. When sits down and does the number crunch on this, it's just that we are going to see, quantum leaps in demand, quantum leaps. It's not just, a 10% or a 20%, CSG, growth number. I mean, for instance, we were debating just before we came in here a substance called graphite. Now, graphite is the thing that goes into the anode in the battery. Where's all the graphite in the world? And what's people doing about creating graphite anodes? The Chinese basically control that market. It's a 1 million ton a year market. 650,000 tons of that is produced by the Chinese. So the free market's 350,000 tons. That market's got to grow by 1 million tons a year to meet the needs of the next 5 years worth of stats or demands which are being made by the car manufacturers, or the Mercedes-Benz, the Volkswagens, the Fords of this world, the motor cars which they're proposing that they're going to make. The demand numbers are going to go up in multiples over the course of the next 5, 6, 7 years. I mean, a key point in my runarounds, Mercedes-Benz, for instance, will tell you that come 2029, which is basically in 5, 6, 7 years' time, they will not produce a diesel motor car and they will not produce a petrol motor car. They'll all be electric. So where's all the stuff that goes, all the minerals that go into the graphite, it goes into the anode and into the cathode and the electrolyte. Where's it all coming from? It has to come out of the mining industry. Now, the state of play in the mining industry is we're way behind. I mean, that's the reality. Our major mining companies, our diversified houses, they don't have energy minerals divisions. Where's the energy minerals division of BHP? Where's the energy minerals division of Rio Tinto and Anglo American? They don't exist. So in other words, our diversified companies are being caught fast asleep in this major boom which is about to happen. And a major boom which is, this is not a 2, 3, 4 year phenomenon. This is going to go on for the next 30 years. We've got a growth plan in this space which is just going to take the world by storm. So what does it mean? There's huge opportunity for our junior miners to get active, because that's where the entrepreneurial spirit will come. And that's going to be a challenge, dare I say it, to our banks. It's going to be a challenge to our investors. It's going to be a challenge to everybody. But the reality is that there are billions and billions of dollars being thrown at this space. If you look at the European Union, for instance, they're talking about a 250 billion euro spend in battery technology development, whatever. But what the politicians don't talk about is where are the minerals. So guys, it's wide open to the miners. It's wide open to this space. I just wish I was 20, 30 years younger so that I could take advantage of it, because it's coming. So that's my view for what it's worth.
Fantastic.
But Rick, well said. You've explained yourself very well. And Nedbank, I would hope that Nedbank can play a leading role here in the Southern African region, in the SADC region. I keep telling everybody that this is also a major challenge for the SADC region. Just simply, 90% of the graphite sits down here, 90% of the cobalt sits in DRC, 90% of the manganese sits in South Africa, 90% of the platinum group metals sit in South Africa. So guys, whether you like it or you don't, South Africa is going to become, or Southern Africa is going to become, an investment agenda for a lot of opportunity and a lot of mining companies as we go forward. It has to happen.
Do you want to chime in, please? Yeah.
Thanks, Lloyd. And I wanted to let you know and reassure you, Nedbank is the largest facility provider to the PGM industry in South Africa, and we are actively pursuing copper and manganese opportunities on the continent and in South Africa.
Well done.
Just a point on the majors, should be diversifying or moving into battery metals. Are they geared up for it? Do they, like, if you think of like the technical capability of a lithium operation, is it something that Rio or BHP really want to take on or have the capacity to do it? They can't just flick a switch. It's quite. I'm just playing devil's advocate here. These are very separate from the disciplines that they've already got in place.
I think to answer your question on that, once again, a challenge, as Rick rightly, Brian, my apologies, Brian. As Brian pointed out, there are challenges, huge challenges. We've got a new industry coming to the world. I mean, dare I say it, the motor manufacturers, how many battery factories are they going to build over the course of the next 3, 4, 5 years? Mercedes-Benz, I think, have got 29 battery factories they want to build, right? Where are they going to build them in the world? We've got to build them probably close to our mines, close to our industries. It means whole new industries have got to be developed. And the skill sets which are needed in those industries is a huge opportunity, dare I say it, for Africa, because the skill sets don't exist. These are new skill sets which are going to have to come with a new industry. It's all a challenge, and that challenge is something which we've all got to rise to. Yep.
Gentlemen, at the end, let's bring you guys in here. Philip, you've been investing globally, not just Southern Africa, across the battery as well as other metals classes. Where do you see the shortages and the tightness? Are you really concerned about graphite similarly? Give us your view, please.
Yeah, I think that we've been fortunate in the fact that we spotted this quite early. We've been working on this as a general project for the last 5 years or so we're quite well positioned. We've got investments right across every single commodity that's needed for this energy transition. And like you say, it's not going to end here. This is a multi-generational thematic, and we will be playing a part in it, no doubt. The question is, how do you, as an investor, play this? And I think in today's market, there are a few things that certainly we think about. The first one is ESG. ESG is literally number one in terms of everything we look at. You cannot get this wrong. As an industry, I think we are growing up. We recognise that it's just the most important thing. You've got to do things right, and everything that we do has ESG at the top of the agenda. So that's number one. Number two, we are in an extremely inflationary environment right now, and so we've got about a dozen projects in our portfolio. They're all really, really tough right now, and I think that if you don't have commodity price inflation along with cost inflation, then you're going to suffer huge margin compression. And certain projects we have, that is a problem. Certain projects, it's not a problem. But I think that one of the key things that we do as an organisation is streaming. Royalties and streaming, I think, are the best way to play the cycle, because you're not at the beck and call of cost inflation. You are top line exposure, and accordingly, that is front and center of everything that we think about. So we've built a portfolio of streams and royalties in energy transition commodities, and we're looking forward to doing that again in the sort of next phase of this transition.
Yep. What's your take on Southern Africa and the sort of importance of this region? Just as we're here down in Cape Town, we're looking at African projects.
Yeah, so I think that I've been at Orion for 6 years now. So during that period, we've made about 4 investments in Southern Africa. We recognise the importance of PGMs. I think that you mentioned PGMs. I think that the hydrogen economy is embryonic at this point in time, but I think that if you look forward across the next decade, I think that we'll see that is an important part of things. And PGMs, platinum in particular, is important for fuel cells, of course. I think that elsewhere in Southern Africa, we've got the copper belt. Let's not forget that the huge amount of copper is required for this energy transition. Cobalt as well for the safety of electric vehicles. Tin, I think, is also an important part of Southern Africa. It's the glue that holds the energy transition together. And other commodities as well. I think people overlook uranium. Uranium is actually going to be an important part of it. The wind does not always blow and the sun does not always shine. Uranium is going to be important. I think that Africa, as a general point, is going to be a huge part of the energy transition.
Fantastic. Hans, could I bring you in here and give us your view on Clarksons? Where do you feel the feed for batteries is going to come from? Where are the tight points? How do you see it in Clarksons?
Hello, everyone, and thanks a lot. And it's good to be back. And all these discussions, Philip and I sat down yesterday and discussed a bit about this. And, you know, what we see from Clarkson's, which is very energy-centric, we were probably the first sort of advisory that advised for wind farms, ships, and installation ships. We were very early on the lithium space. What we really see and is missing that I think is the most important is to see the banks coming back seriously with size for project financing. For the last 3 years, all of the financings we have arranged for companies is mainly because there is a lack of banks, and that have made the capital too expensive for ordinary margins. Nedbank, great here in South Africa, but in general, we have seen that all the banks have been pulling out of the traditional certain energy, whatever it is, oil, gas, mining, and so on. I think that's a big point that ESG and the industry is accepted and is back in the portfolio of the big banks. So that's number one. The second part we do see is that the world have now, with the pandemic and this unfortunate situation in Ukraine, we've seen that the focus on supply chain and the focus on metals and minerals is back on the agenda for everyone. When it comes to ESG, to be honest, I think it's a need to have. And all this, what I would call greenwashing, is gone away. It's going to what you do. And we financed e.g. a copper mine in BC as an example, where rather wind or hydropower is a big part to partly replace traditional fuel. It's not like you can be zero or have no footprint day one, but you really have to do something with it. When it comes to the investors, last 3-4 years, Africa risk have been a challenge. I think that is on its way to change substantially. We do see demand for equity investments now by general investors and so on. So I think it's a bit that we need to build a bit larger companies. The traditional exploration developers that have market caps wherever they are listed below $500 million US dollars. Unfortunately, qualified investors don't look at them. So I think that we need to think larger. It has to be size and portfolios, and the banks need to really come back to the market. I think that's the 3 items that we do see most of the time. Yep. And, you know, it is quite fascinating. We did 5 or 6 different sort of senior secured development bonds for mining companies last year. We've seen that the swap rate have come up, the spreads for what's typical single B risks have come out, but these, with the raw material prices, they have really tightened in spread. So it tells investors are looking at the sector, they are providing capital again.
Right, yeah, because the metals prices are much higher now. You know, if you think back to a few years ago, though, the stock price of some of the companies who are here today wasn't that high. Now some of them, you know, sort of $1 billion, a handful of them certainly are. So is it starting to change? Are you starting to see this movement in the right direction, or is it still not enough, like you say?
I would say that direction is upward and forwards, but it's going, as always, to be a very bumpy ride. And I think that that's something that investors have to deal with, because if you're an equity investor in these markets, it's not going to be a straight line. Yeah. All these minerals is needed, but it's going to be a bumpy ride for everyone, and investors have to be prepared for that.
Just a quick point on your ESG, because I wanted to tie something in. Philip and yourself could answer this one maybe, but are you paying more for projects with good ESG criteria now? Are you willing to? Is that an essential thing? Is it slowing down capital allocation process?
I think maybe Philip can say more about it, but there is no one that I do see that get more or premium for their steel or aluminium or whatnot. It is what it is. There is no premium for green steel or something like that. So the industry have to change in general. The good thing is there are margins there now to take those investments.
It depends who you talk to, basically. So I think that for us, as a general concept, it's a bright line, right? We are not going to invest in a company unless it adheres to industry best practice, and that's right across the board. You know, if it's in a non-designated country. We're looking for IFC performance standards. We're looking for GISTM tailings management. It just is a yes or no question for us. But if you go east, the criteria is perhaps a little bit more relaxed. And so we do see investors that come into clubs with us that perhaps don't have quite the same standards, and they're quite taken aback by some of the things we ask of our portfolio companies. But I think that this is only going in one direction. In terms of commodities, it's something that people talk about. Like, are you going to pay more if your cobalt is green? I think that it's starting to happen, but right now there's no bifurcation in terms of any liquid market that I've seen.
Fair enough. Brian, you look like you might want to jump in on some of those questions. Do you have anything to say?
On the subject of pricing of product as a result of ESG standards or compliance, I agree with you. There's no obvious sign of a dual market that pays a premium for product that has an ESG compliant origin. However, as you've mentioned, access to capital to develop is totally ESG compliant, and hence cost of capital to finance projects is ESG compliant, and increasingly access to market is ESG compliant. I mean, we spend quite a lot of time with our TechMet Mercuria trading platform with GM and Ford and Tesla and VW, and they all increasingly will do require traceable and independently verifiable ESG across the supply pipeline and low carbon footprint across the supply pipeline. And increasingly they'll participate in the capital structure to again reduce cost of capital in order to ensure the compliance of their supply pipeline and preferential access to product. Just one other big picture comment. I think we will and the world will continue to be failed by the big mining companies. They're conservative and bureaucratic and are very ill-equipped to focus on mid-tier project, which dominates the supply landscape for a lot of these critical minerals. We'll continue to be failed to an extent by the banks, and the banks, and you're, an exception relative to some. But again, there's a conservatism and a adherence to sort of formulaic processes that limit the extent to which you can scale engagement in different types of projects that are important to the transformation of this space. So this is really, if one positive thing comes out of this gathering in Cape Town, it should be a call to arms to the junior mining sector and to governments in Africa to be at the forefront of this transformation. This is a once-in-a-generation opportunity for small companies to become big companies by thinking big, being confident, and being imaginative with respect to how you access financing support from the Fords and GMs of this world, who increasingly have come to the realization that their concern with respect to security of supply of battery metals to feed the tens of billions of dollars of capacity that they're building to electrify their fleets over the next 2, 5, and 10 years requires them to take equity type risk in metals and mining to secure product to feed this capacity. So there's an opportunity there. The US government, they've figured out the landscape and are desperate for help and partners to deploy capital and support to counter China's dominant position across these supply pipelines and scale global supply in a US aligned manner. We've got, it's TechMet, we had direct US government equity investment through the DFC. So it's possible. It's unusual. In fact, we're the only one ever. But it's tortuously difficult, but it will become easier. So there's a whole universe of support and financing that the junior mining company, in the process of taking small companies and making the big companies and the Rio Tintos and BHPs and Anglos of the next generation in 10, 20 years' time, can access now. And governments in Africa, who have these resources that could be enormously important, as Lloyd pointed out, to the scaling of supply in these critical minerals, need to, think big and think of how they can create an enabling environment that draws in these new sources of capital that are increasingly having to focus in this space. And that, again, is not happening, but it needs to happen and needs to happen urgently.
Yeah.
I think that we're becoming fashionable in the mining sector. I'm just recalling over the past couple of months, I think I've had a call from an OEM nearly every single week. Yeah. So what are you doing with Horizonte? What are you doing with Serra Verde? You know, they're just desperation is the word you mentioned, and it's starting to set in. Panic is starting to set in. And I think this is really genuinely a new super cycle. And it's exasperated by the fact that we've got inflation ripping through the economy. It's exasperated by the fact that supply chains are really struggling. It's very hard to get projects done. I think that commodity prices are here at these levels for an elongated period of time. And so this is, as you say, a moment for the junior miner sector, and now is the time to think big.
Are we going to get to a situation where an OEM is going to have a default on a contract because there's not enough, is that on the horizon, given how expectant the downstream element is of the supply that's coming through for these batteries?
Yeah. No, I think it's worth illustrating how severe this supply-demand dislocation is just looking at the EV ecosystem for the global OEMs. The total committed capital on the part of the big global non-Chinese OEMs to build capacity to electrify their fleet is now around $550 billion over the next 3 or 4 years. So they're all building massively increased lithium-ion battery manufacturing capacity with partners. They're all building massive capacity to manufacture electric vehicles with a view to being all electric or largely all electric over the next 5 or 10 years. And it's becoming an inescapable inevitability that in 5 years' time, this massively increased capacity on the part of VW, Ford, GM, Tesla, and everybody else is going to be sitting half idle because they just simply cannot procure adequate feedstock to feed the capacity and supply the demand which they are creating, and which again is unstoppable and inescapable. And this is quite apart from, if you look at Tesla's plans are to produce 20 million electric vehicles a year in 2030. That would require 3 times the present total global annual supply of lithium. And that's just Tesla. Before you look at VW and Ford and GM, and before you look at the Chinese manufacturers who are growing as fast or faster than anybody else and will continue to dominate in this space. So we have a major, major crisis. And as you say, that the OEMs are waking up to this. They're waking up to it 4 years too late. But they are coming to the realization that they're going to have to take equity type risk in the capital structure of mining and metals to ensure preferential access to supply of product. And that's new. When we were speaking to GM a year ago, they were saying we want offtake with price smoothing. And in return for that, we'll lend you our name and you'll be more fundable because you'll have a guaranteed market for your production. And we luckily said no. And now they're saying, how can we secure preferential access to product at market prices, whatever they're going to be in? We know they're going to double again because they have to stimulate supply to start to meet this demand. So how can we invest equity in mining projects? And that's a massive turnaround and a massive opportunity for the industry, because these are big companies committed to 10, 20, 30, $50 billion of capital, to transform their company's product range over the next 5 years.
Hans, you wanted to jump in?
I think that this is pretty fascinating because I agree, and I do see that Volkswagen and Mercedes and so on is running after Tesla. Tesla have the market cap to do something. But the really good opportunity, in particular for the junior miners, is that when you see these super margins that we see in lithium and cobalt in these days, even with the inflation you talk about, Wall Street will technically fix it. There will be capital available when you have these super profits. And I think that's where one of the opportunities are for the equity side that will be provided by the capital markets. And then, as I mentioned, we need to see the banks coming along across the globe. And, if there is one continent that really have the big opportunity, it's Africa. And I do think that particular manganese and cobalt is going to be the big thing. But we also have to look at what are electrification doing. Copper is going to be huge for a long, long time because the grid is going to be upgraded, the charging station is going to be upgraded, the windmills is going to be built. Where is all this copper going to come from? If you look at Siemens now, in their largest windmill. Is anyone knowing how many tons of copper it sits in that one windmill? It's 8 tons of copper sitting in that engine in each of the windmills that they're building now. And that's new incremental demand for copper. So I think the opportunities is great. I think capital is available, and particularly equity. Then I'm more uncertain about the banks. When we were speaking with banks in relationship to the Glasgow meeting, everyone says mining, no, out of the policy. We're not going to finance it. And that's where the government have also to push the banks. It's have to be allowed to finance mineral resources.
Yeah. Kathy, do you want to chime in there and represent the banks
absolutely.
here?
There's been a lot of commentary around availability of funds from commercial banks. And from a Nedbank perspective, we're fortunate we've had a continuous mandate to fund for the last 10, 15 years. We have an uninterrupted mandate. We're comfortable with Africa. We're comfortable with all the commodities other than alluvial diamonds. And, we've been a through the cycle banker. Fortunately, we've made good investment choices and we're still here. We've seen our competitors come in and out of the market, but there is definitely a very strong pool of South African banks and international banks that have mining capabilities and Africa funding capabilities. So I do believe the debt is there from the commercial banks.
Touché. Wonderful. Okay, so I'd like to open to the floor if anyone has any questions while our panel is up here. Anyone got anything quite pressing? Yep, gentleman down here. Do you have a roaming mic? No, okay, sorry. You shout, I'll repeat. China, yes, we touched on it. Yeah. Yeah. What? Yeah. Chinese investment and acquisitions in Africa. You think about a lot of mines that were previously with Western ownership have now been acquired or moved into Chinese ownership. The battles there, we've mentioned it. Can anyone see the landscape changing in the near term? Shall I have a go? Please.
All right. So it's a bit of a tough call to say where the Chinese are going, what they're doing. I mean, I've been over the course of the last 3-4 years, I've been running around in this part of the region, the SADC region, trying to look to acquire assets in the battery mineral space. And it's quite interesting where you go. Obviously, the Chinese have got a strong presence in different parts of the SADC region. And I can only really talk the SADC region because that's where I've been. Clearly, in Namibia, they're big. In Mozambique, they're big. In Zambia, they're big. In this country, not so big. In Botswana, not so big. But an overriding comment I'd make around the attitude in this part of the world is that people, frankly, are, they've had their Chinese experience and it hasn't necessarily been a good one. And I think going forward, what it will mean is that the Chinese will struggle with in the political arena, certainly in the SADC region, because of their behavior historically. That's the one point. The second point is that if the big monies are truly going to flow into Africa, into these projects, the behavior of governments has got to be appropriate. And dare I say it, we talked briefly about ESG debate, and clearly behavior around ESG and trying to do things properly and with a good conscience is also important. I don't wish to be overly critical, but I don't think the Chinese behave too well on any of those counts. And what we will see is as money begins to move into the African continent, it's my hope, and I stress it's my hope because I've ran into a number of brick walls with politicians and the way that they behave. It is my hope that governments in Africa begin to recognize that they have a real opportunity to do something of substance for their countries. Once again, the grey matter here, I've been around for many, many, many years, formerly JP Morgan, and funding lots of different things in different parts of Africa. This whole issue of, dare I say it, corruption and dare I say it, bad behavior on the part of politicians has been a real issue. And it has frightened off a number of the major companies from doing business in the region or doing business in Africa. And it has been a huge problem. But when I engage with the various politicians, whether it be ministers of mines, ministers of finance, or dare I say it, even presidents' councils and presidents themselves, my messaging to them is very straightforward. I say, guys, listen, you all have a big whinge about the fact that in the 1940s, 1950s, and 1960s, that the copper industry developed up there in Zambia and northern Rhodesia and Rhodesia, and that we had a gold industry here that developed here. We had a manganese industry that developed. We've had, dare I say it, some big iron ore assets in the region, particularly Kumba. And the big issue amongst, dare I say it, our new generation of politicians has always been one of, well, the beneficiation disappeared out of the country. We didn't get the value chain. We didn't capture the value upliftment because all the value upliftment was in the beneficiation, which disappeared from the region. Now, I throw it out there to all the politicians. Guys, wake up. There's a huge opportunity here in Africa for you as political leaders to set the benchmark around behavior and make sure that we behave properly as a region and allow this whole new industry, which we've talked about, when I talk about beneficiation, all the way through from pulling the nickel out of the ground or the cobalt out of the ground and manufacturing, putting a battery factory in place, which is these gigawatt factories cost billions of dollars. So there's a huge opportunity for investment in the region. There's a huge opportunity for bringing skill sets, and dare I say it, a huge opportunity for employment. But the politicians need to wake up, and they need to put a clamp on all of this nonsense which they've lived with during this issue of corruption and bad behavior. They need to jack their act. They need to get focused, and they need to create the environment so that all these investment dollars, which we all talk about, can actually flow. And that is something which I've harped on hard in the SADC region with all the presidents of this region. And they're all online with that. I mean, even to the point where I've actively engaged with the head of SADC about this, and everyone buys into the argument there's an opportunity to fix things in this part of the world with respect to behaving properly and bringing investment dollars in. That opportunity is recognized. Now, with respect to the Chinese, I think just the comment on the Chinese is, as I say, they have captured the market in, as you rightly point out. They produce probably about a third of the world's motor cars at the moment, and I'm sure they're going to want that to continue to grow. And I'm sure that they're going to fiercely compete to try and source the mineral to do what they need to do. But this is now a question within the political arena, is behave properly or don't behave properly. If you're not behaving properly, well, then we've lost the battle with the Chinese guys.
Brian.
I think that
Controversial, but those are views.
I think there are two levels to Chinese overwhelmingly dominant control of the supply chain of these critical minerals. One is control of primary resource, and they've done a great job of buying projects and securing control in the Congo and elsewhere of these key metal resources. And the other is controlling processing capacity to take these primary resource and turn them into high purity metal chemicals to go into batteries and other technologies, and that's largely in China. And that's one can compete with them to an extent for copper cobalt resources in the Congo. They're very strong, but the Congolese government are desperate to bring in US and other aligned investors in order to balance Chinese overwhelmingly dominant control. As Lloyd said, they haven't always behaved well and are not always popular, and therefore there's a desire to reduce their dominant position. With respect to processing capacity, it's a massive problem. The reason why they dominate in lithium conversion and cobalt processing and nickel processing is because they've built critical mass in China while everybody else was sleeping. They've done that with cheap government money. They've done that with lower environmental licensing standards. And they've now got a position that's really difficult to compete with. And again, this is an opportunity for Africa. It's very nice for African governments to say, we want beneficiation at home because we want to add value and create more economic activity domestically rather than just export raw materials and continue the legacy of imperialist exploitation of the wealth of our nation. But in order to do, and the natural kind of tendency is to say, you have to beneficiate at home, otherwise we're going to charge you additional taxes or additional duties to export unbeneficiated raw materials. And that's the wrong way to think about it. The right way to think about it is to say, how can we create an environment domestically where the development of processing capacity can be competitive with China? And how do you do that? You reduce the cost of capital by reducing risk. You reach out to countries like the US who are desperate for partners and solutions to balance China's dominant position, and therefore are very open to government de-risking and support mechanisms to reduce cost of capital and increase investment into beneficiation. And you create a supporting environment to make building capacity and manufacturing cheaper. And there's a massive opportunity to do that.
Yep. Philip, do you want to?
Yeah, just one comment on that. I think that as an investor, though, it's not quite as simple. It's not, this deglobalization agenda is not going to happen overnight. And I think that when you look at some of the commodities and the sort of downstream processing that's required for these things, it's very hard to not work with China. It's not something that's going to happen overnight. So, for example, we're an investor in an important rare earths project in Brazil. It's an ionic clay. It's in construction right now. But if they said to me, we're going to build a downstream processing plant, we're going to build some magnets, that would scare me off. I'd much rather take the Chinese risk and put it into China right now, and then perhaps see that as a sort of second phase to the project. So I think we need to work with China as opposed to work against China.
Interesting view. Hans, do you want to?
Yeah, I think I'll just add on what was said here is about sustainability and behavior and so on. And if the industry want to attract the generalists, sort of qualified investor money, not the people that do what Philip and his team, those that go in and do checking the tailings and so on, but reputation, whatever it is for ESG or bribery and long-term and tax stability, is extremely important to get all these general investors to come back to the industry as well. We need to keep in mind that a portfolio manager on 67th floor in New York that have 3 or 4 or 10% of the portfolio in mining, he's not a mining specialist. And their funds is coming in, is going on the reputation. So reputation risk is something the industry really need to take care of. And it's all these components that we're talking about here. Investors don't want to be on the front page of Wall Street Journal or FT that you was financing a disaster someplace. So behavior and reputation is important for those investors that have the big checks, but is outside the industry.
Okay, we're going to have to call it there, I'm afraid. It's been fantastic and really revealing some clear paths to progress, but also a lot of challenges in the way. Thank you very much to my panel for giving us their views this morning. Round of applause, please.